Hello friends, this is Victor here. Welcome back to the Intelligent Investor channel. In this video, I'm going to talk about these two important topics because they're related to each other. First, I'm going to talk about why I believe the market has already bottomed. Second, I will explain whether Tesla stock is still a great company for long-term investing. As always, I would like to give you more context first. At the time of making this video, the market is still in a major correction or bear market, mainly because of Donald Trump's trade war and reciprocal tariffs, which have affected most countries and many businesses around the world. The market is still extremely fearful. Investors are concerned that the US may head into a recession or even stagflation in the upcoming months. About 1 week ago, the S&P 500 had dropped by as much as 20%. It has recovered slightly after Trump announced a 90-day pause on reciprocal tariffs for most countries except China. The tech-heavy Nasdaq 100 has dropped even more. The Nasdaq 100 was down as much as 22% from its recent peak. Now, it has recovered slightly after Trump announced a 90-day pause on reciprocal tariffs for most countries except China. As for Tesla stock has dropped by as much as 50% from its recent peak. It has surged the most during the Trump rally because investors were speculating that Trump would help Elon Musk gain faster approval for Tesla's upcoming unsupervised FSD and Robotaxi service across the US. Now, Tesla stock has dropped more than most tech stocks because of Trump's trade war, Tesla's damaged branding, and slower than expected EV growth. Here's the important part you should know. More than 70 countries have already contacted Trump to negotiate new trade agreements. At the time of making this video, China is the only major country that has not reached out to Trump yet. More importantly, both the US and China have raised tariffs on each other to over 125%. At this point, the trade war is mainly between the US and China. I like this meme. By 2045, the US and China will still be raising tariffs on each other. This trade war will never end. Of course, it makes no economic sense for both countries to keep raising tariffs above 100%. It's a lose-lose situation. If they don't lower tariffs, their economies will likely slip into recession. So it's only a matter of time before they pick up the phone and negotiate new trade agreements. Right now, both sides are waiting to see who gives in first. So in this video, I will explain why I believe the market has already bottomed. I will also talk about whether Tesla is still a great company for long-term investing. If you like this video, make sure to hit the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock analysis videos every week that will help you become a great investor. Each video usually takes me more than 30 hours to make. So if you like this channel and want to support it, check out my Patreon blog in the video description. Our goal is to help all our members become multi-millionaires through investing. Once you become a premium member, you can follow all the stocks I'm investing for the long term, follow my personal stock portfolios, and download the latest intrinsic valuation models for all the stocks I'm analyzing, so you'll know when a company becomes undervalued, fairly valued, or overvalued now. Also, you will have access to all my latest stock ratings for all the stocks I'm analyzing. The link is in the video description. Take a look, let's start. This is my prediction. I believe the market has already bottomed. There are several reasons. First, about a week ago, the fear and greed index was as low as 4. After Trump announced his reciprocal tariffs, it was the lowest I've seen over the past 10 years. Now, the fear and greed index has recovered slightly to around 13 after Trump announced a 90-day pause on reciprocal tariffs for most countries except China. Second, the entire market is still greatly undervalued and oversold, mainly because of Trump's trade war and reciprocal tariffs. Most companies' business fundamentals have not changed at all. Most S&P 500 and Nasdaq 100 companies are still greatly undervalued. Typically, most companies cannot stay deeply undervalued for too long. They will eventually recover to around their fair values over time. Third, the US Consumer Sentiment Index is now near the lowest point over the past 10 years. It is as low as during the bear market in 2022. Typically, the Consumer Sentiment Index is exceptionally low when the market is also near the bottom because consumers don't want to spend money to buy things when they're losing a lot of money in the equity market, crypto market, and other markets. Most countries have started contacting Trump to negotiate lower tariffs and new trade agreements. At the time of making this video, China is the only major country that has not contacted Trump yet. Once the US and China reach new trade agreements and lower their tariff rates, the market will recover much more. Fourth, Trump decided to pivot and pause his reciprocal tariffs on most countries because he does not want long-term treasury yields to increase too much. He started this trade war intentionally to bring more manufacturing back to the US, reduce the US large trade deficit, and lower the US national debt. He also wants the 10-year treasury yield to drop significantly so the US government can refinance its debt at a much lower rate than before. But here's the biggest issue right now. Trump's reciprocal tariffs have caused the long-term 10-year US treasury yield and the 30-year treasury yield to be much higher than before. This means the US government will need to refinance its debt at higher rates than before. This is the opposite of what Trump initially wanted. This is why Trump had to pivot and pass his reciprocal tariffs to calm the market. Typically, when there are a lot of uncertainties in the market, investors will sell their stocks to buy more US Treasuries because US Treasuries are supposed to be the safest investments in the world as long as investors hold them until maturity. Of course, as more people buy US Treasuries, US Treasury yields will decrease. Now, the bond market has been selling more long-term US Treasuries. I believe this suggests that investors lack confidence in the US economy, which is why they demand higher yields, or they believe that Trump has gone too far with his reciprocal tariffs, which will likely push the US into a recession or even stagflation. Fifth, I believe Trump will eventually give more tariff exemptions or lower tariffs going forward, depending on the sectors and how important these sectors are to the US. For example, right before I started making this video, Trump announced that smartphones, laptops, PC components, and semiconductor equipment tools will be exempt from his reciprocal tariffs. Instead, many tech products and semiconductors will likely get separate tariffs based on their sectors and categories in the upcoming months. Of course, Trump has the tendency to go back and forth with his trade policies and confuse the market at the same time. But if this article is correct, I believe it's a huge positive, especially for Apple, TSMC, Nvidia, AMD, Microsoft, Google, and other major US tech companies because it shows that these major tech companies are too important for the US. The US government does not want to impose high tariffs that will greatly impact the US big tech businesses and make them less competitive than the Chinese tech companies. For example, it would not make sense for US consumers to pay over $2,000 for an iPhone because of Trump's tariffs. It also does not make sense to manufacture iPhones in the US, at least in the short term, because labor costs are too high compared to China. More importantly, the US does not have enough skilled workers, the expertise, and the advanced manufacturing tools that are needed to produce iPhones at very low cost like China. Apple CEO Tim Cook said this many years ago. It is still true today. It's not realistic at all to bring iPhone manufacturing to the US. China just has many structural and manufacturing advantages compared to the US, and it's not all about the lower labor costs.
There's a confusion about China, and let me at least give you my opinion. The popular conception is that companies come to China because of low labor cost. I'm not sure what part of China they go to, but the truth is China stopped being the low labor cost country many years ago. The reason is because of the skill, the quantity of skill in one location, and the type of skill it is. Like the products we do require really advanced tooling, and the precision that you have to have in tooling and working with the materials that we do are state of the art. And the tooling skill is very deep here. You know, in the US you could have a meeting of tooling engineers and I'm not sure we could fill the room. In China you could fill multiple football fields. It's that vocational expertise is very deep, very, very deep here.
Sixth, this is my prediction. I don't think China will retaliate further because the Chinese economy is not great at all. Many Chinese companies, especially the manufacturing companies that ship many products to the US, are going out of business because of Trump's trade war and high tariffs. China initially targeted a GDP growth of 5% this year. Now, China's GDP growth is expected to be much lower this year because of Trump's trade war. The Chinese real estate market is still experiencing a large downturn. Consumers are spending less because they want to pay down their debt and save more. Also, China has been experiencing deflation in recent years because of overproduction, especially in goods like EVs. While demand both domestically and internationally has not kept up with overproduction. If we consider all these economic factors and why Trump wants to keep the US Treasury yields low, I believe the US and China will eventually reach new trade agreements and lower their tariffs in the upcoming months. Both countries know that this trade war is a lose-lose situation. If they allow it to continue, both economies will likely end up in a recession. So once they reach new trade agreements and lower their tariffs in the upcoming months, I believe the market will recover much more moving forward. We just need to be patient and wait. Let's talk about Tesla. Is Tesla still a great company for long-term investing? I used to be very bullish on Tesla. However, since last year, I've changed my view on Tesla after Elon Musk started focusing on other businesses other than Tesla. As of now, I believe Tesla is no longer a great company for long-term investing because of several reasons. First, let me read this excerpt from Warren Buffett's shareholder letter. Our goal in both forms of ownership is to make meaningful investments in businesses with both long-lasting favorable economic characteristics and trustworthy measures. Please note, particularly, that we own publicly traded stocks based on our expectations about their long-term business performance, not because we view them as vehicles for adroit purchase and sales. That point is crucial. Charlie and I are not stock pickers. We are business pickers. Buffett explained that he likes to invest in wonderful businesses that have long-lasting, favorable economic characteristics and trustworthy managers. If we measure Tesla against these two key characteristics, I believe Tesla is no longer a great company for long-term investing. The reason is this. First, Tesla no longer has a strong economic moat. Tesla used to have a large cost advantage over other EV makers because of its vertical integration and large economies of scale from producing millions of EVs. But now, Tesla is facing much tougher competition from Chinese EV manufacturers that can produce cheaper EVs. Tesla's upcoming Robotaxi service and Optimus humanoid bot will also face strong competition moving forward. Second, Elon Musk is not focused enough. He has many businesses to run outside of Tesla, including XAI, X, SpaceX, the Boring Company, Neuralink, and now the Department of Government Efficiency or DOGE. Based on my experience investing for many years, the best CEOs are the ones that are 100% focused on one business and not many businesses. This is why I decided not to invest in Tesla anymore, even if Tesla will eventually recover more. As you may already know, Tesla's branding has deteriorated a lot in recent months because of Elon Musk's involvement in politics. He started supporting Trump, running the Department of Government Efficiency or DOGE, cutting costs across the government, which upset a lot of people, and becoming one of Trump's closest advisors. On top of that, Trump's trade war and reciprocal tariffs have hurt Tesla's business. Many people who do not like Trump and Elon have been boycotting Tesla, which has also damaged Tesla's brand. In the end, it's Tesla shareholders who are paying the biggest price. If Elon had stayed out of politics, Tesla's branding wouldn't be as damaged as it is right now. A lot of people will still be buying the Model 3 and Model Y instead of switching to other car brands. Also, Tesla's forward PE is around 94, which is still too high. It's much higher than the forward PEs of other Magnificent 7 companies, even though Tesla is not as profitable. Tesla is no longer growing as fast as it used to be, so a forward PE of 94 or higher does not make any sense. Tesla's current valuation will only make sense if the company can achieve full autonomy and if its Robotaxi service becomes very profitable in the next few years. In terms of financials, Tesla is selling more EVs and is earning high revenues compared to several years ago. But the biggest issue is this: Tesla's operating income, operating margin, free cash flow, and free cash flow margin peaked in 2022 when Tesla sold even fewer cars. Tesla had much less competition before. This is why the company could earn much higher margins. Now, Tesla is facing much more competition than before, especially from BYD and other Chinese EV makers. To increase demand, Tesla has to compete on pricing by lowering EV prices and offering low interest rates to customers. This is why Tesla's profit margins have dropped significantly in recent years. This trend will continue as long as Tesla is still in the EV business. Just to give you an example, if you look at Tesla's gross margin, operating margin, and free cash flow in 2022, you can see that they were much higher. Last fiscal year, Tesla's EV revenues and energy and storage revenues were higher than in 2022. Yet, its gross margin, operating margin, and free cash flow were much lower compared to 2022. These financials show that Tesla is facing a lot of competition. If Tesla has a huge moat, Tesla would not need to compete on pricing and have very low margins like now. These decreasing margins show that Tesla no longer has any moats. Of course, we have to look forward when it comes to investing. According to this consensus forecast here, Tesla's revenue is expected to grow by around 11% this year, followed by around 20% each year over the next 2 years. Moreover, Tesla's EPS is expected to grow by around 32% this year, followed by similar 30% plus growth rates each year over the next 2 years. Realistically, Tesla's growth rates should be much lower this year because of Donald Trump's trade war and high tariffs. Many people are still boycotting Tesla and switching to other car brands instead. Tesla's current valuation is mainly dependent on its upcoming Robotaxi service. Tesla's valuation would be much lower without FSD and its upcoming Robotaxi service. Tesla's forward Ps will only make sense if Tesla can achieve full autonomy and dominate the Robotaxi market in the upcoming years. I want to show you the most important parts of Tesla's last earnings call, where Elon Musk shared his vision for the company. He acknowledged that Tesla's EV business is facing intense competition and is no longer growing as quickly as before. That's why in recent quarters, Elon has shifted Tesla's focus from selling EVs to the Robotaxi service and the Optimus bot. He believes that these two businesses will be the biggest growth drivers for Tesla moving forward. He believes that Tesla will eventually become the most viable company in the world. This is what he said.
We made many critical investments in 2024 in manufacturing, AI, and robotics that will bear immense fruit in the future. Immense. Like it's, in fact, to such a scale that it is difficult to comprehend. And I've said this before, and I'll stand by it. I see a path. I'm not saying it's an easy path, but I see a path to Tesla being the most valuable company in the world by far. Not even close. Like maybe several times more than. I mean, there is a path where Tesla is worth more than the next top 5 companies combined. There's a path to that. I mean, I think it's like it's like a difficult path, but it is an achievable path. And that is overwhelmingly due to autonomous vehicles and autonomous humanoid robots. Our focus is actually building towards that. And that's what we're laying the ground. We laid the groundwork for that in 2024. We'll continue to lay the groundwork for that in 2025. In fact, more than lay the groundwork, actually, so be building the structure. We're building the manufacturing lines. I'd like setting up for what I think will be an epic 2026 and a ridiculous 27 and 28. We launched the Cortex training cluster at Gigafactory Austin, which was a significant contributor to FSD advancement. And we continue to invest in training infrastructure at our Texas headquarters. So the training needs for Optimus humanoid robot are probably at least ultimately 10x what's needed for the car, at least to get to the full range of useful roles. You can say, like, how many different roles are there for a humanoid robot versus a car? A humanoid robot has probably 1,000 times more uses and more complex things than in a car. That doesn't mean the training scales by 1,000, but it's probably 10x. Now you can do this progressively, so it doesn't mean like Tesla's going to spend like $500 billion in training compute, because we will obviously train Optimus to do enough tasks to match the output of Optimus robots. And obviously the cost of training is dropping dramatically with time. Like, it's one of those things where I think long-term Optimus has the potential to be north of $10 trillion in revenue. Like, it's really bananas. So then you can obviously afford a lot of training compute in that situation. In fact, even $500 billion of training compute in that situation would be quite a good deal. The future is going to be incredibly different from the past, that's for sure. We live at this unbelievable inflection point in human history. The proof is in the pudding. So we're going to be launching unsupervised full self-driving as a paid service in Austin in June. I've talked with the team. We feel confident in being able to do an initial launch of unsupervised, no one in the car, full self-driving in Austin in June. We already have Teslas operating autonomously, unsupervised full self-driving at our factory in Fremont, and we'll soon be doing that at our factory in Texas. So thousands of cars every day are driving with no one in them at our Fremont factory in California. They will soon be doing that in Austin and then elsewhere in the world at the rest of our factories, which is pretty cool. And the cars aren't just driving to exactly the same spot, because obviously it all wouldn't collide at the same spot. The cars are actually programmed with what lane they need to park into to be picked up for delivery. So they drive from the factory end of line to their destination parking spot to be picked up for delivery to customers. And they're doing this reliably every day, thousands of times a day. It's pretty cool. Like I said, the Teslas will be in the wild with no one in them in June in Austin. So what I'm saying is, this is not some far-off mythical situation. It's literally 5 months away type of thing. And while we're putting our toe in the water gently at first, just to make sure everything's cool, our solution is a generalized AI solution. It does not require high precision maps of a locality. So we just want to be cautious.
There are two camps right now, the bull thesis and the bear thesis. The bulls believe that Tesla will achieve full autonomy in the upcoming months. More importantly, the bulls believe that Tesla's upcoming Robotaxi service will disrupt Uber, Waymo, Lyft, and dominate the ride-hailing market. I believe the Robotaxi service is essentially a moonshot investment. The bulls also believe that Tesla's Optimus humanoid bot will disrupt many manufacturing businesses, and that it will become a much larger market than its EV business in the upcoming years. Realistically, this is also a moonshot investment. If I'm being realistic, I believe there are other more reasonable positive catalysts for Tesla, such as unsupervised FSD, more affordable EVs, stronger growth in the storage and energy business, and Elon stepping away from Dodge to focus more on Tesla. These catalysts are much more reasonable and achievable. On the other hand, Tesla has many more negative catalysts or major headwinds than positive catalysts. For example, the bears believe that Tesla has no moat and faces too much competition. This is why Tesla has to compete on pricing and has much lower margins than before. The bears also believe that Tesla is only a car company. Its valuation is too high, and its current valuation is mainly dependent on Tesla's FSD and its upcoming Robotaxi service. Tesla also has many negative headwinds, such as damaged branding, Elon getting distracted by other side businesses, Elon's involvement in politics, slower than expected EV growth, low margins like a car company, high tariffs, and the ongoing trade war. Right now, I'm leaning more toward the bear thesis because I believe these bear cases are much more reasonable and realistic. In comparison, I believe Tesla's two largest growth drivers, Robotaxi service and Optimus bot, are still considered moonshot investments. Elon stated that Tesla will launch its Robotaxi service by the middle of this year, starting in Austin, Texas. Tesla will first use Model 3 and Model Y with unsupervised FSD for its Robotaxi service. Tesla is planning to start mass producing the Cybercab in 2026. At the same time, Tesla will launch its Robotaxi service gradually across the US and eventually other countries once it receives regulatory approval. Let's consider this. First, if Tesla gets regulatory approval and launch its Robotaxi service today, it will still face a lot of competition from Waymo, Uber, Lyft, and other ride-hailing services. Tesla will still need to compete on pricing and make sure that there are at least thousands of Robotaxis on the road to meet customer demand. If Tesla does not have enough Robotaxis on the road in many cities, customers will still choose Waymo, Uber, Lyft, or other ride-hailing services, even if they are more expensive. Second, Uber has a major competitive advantage over Tesla, known as network effects. At the time of making this video, Uber already has over 170 million monthly active users and more than 8 million monthly active drivers across many major cities around the world, and these numbers continue to grow almost every month. Tesla will have to compete with Uber on both the supply and demand sides. On the supply side, Tesla will need hundreds of thousands of Robotaxis on the road to match Uber's ride-hailing service. On the demand side, Tesla will need to make sure that there's enough customer demand for its Robotaxi service. Each Robotaxi needs to have enough rides to earn enough revenue to cover its operating costs every day. Scaling both the supply and demand sides of a ride-hailing platform is not easy at all. Third, Tesla's Robotaxi cost per ride will likely be much higher than what Elon Musk originally claimed. He initially estimated that the cost per mile would be around 30 to 40 cents. This is significantly lower than the average ride-hailing cost of about $2 per mile. This low cost per mile is supposed to be the Robotaxi service's biggest competitive advantage. However, I believe Elon's estimate is completely wrong. In reality, Tesla's cost per ride will likely be much higher than 30 to 40 cents per mile. Here's why. If you want to invest in a Tesla Cybercab and use it for ride-hailing services, you will need to spend around $30,000 or more upfront to buy or finance the car. Based on my understanding, Elon Musk's estimate of 30 to 40 cents per mile did not account for all the operating costs, including the cost of purchasing or financing the Robotaxi, daily maintenance and cleaning the car, buying the car insurance for business use, running the Robotaxi service, marketing to make sure that your car gets enough rides every day, and paying Tesla to manage the vehicle for you. So when you factor in all these expenses, I believe the actual cost of operating each Robotaxi will likely be closer to $2 per mile and not 30 to 40 cents per mile as Elon Musk originally claimed. And fourth, Tesla's upcoming Robotaxi service cannot be much cheaper than Waymo and Uber because Tesla will need to earn enough revenue from each ride to cover the operating costs. Tesla will also need to share its revenue with other Tesla owners who rent out their Model 3 and Model Y to the Robotaxi fleet. Let me give you an example here. I think this example indicates that Tesla's upcoming Robotaxi service will likely be priced almost the same as Waymo, Uber, and Lyft. According to Perplexity, Waymo's average cost per mile is dependent on the location, customer demand, time of the day, and of course, distance. Waymo's average fare per mile can be around $12 without surcharge or $14 during peak hours. Interestingly, in LA, Waymo rides are often more expensive than Uber rides. Now, what about Tesla's Optimus bot? Realistically, Tesla's Optimus bot is another moonshot investment. It has a lot of growth potential, but many companies such as Boston Dynamics, Figure AI, and Unit 3 Robotics are also making humanoid bots. Almost all of them are partnering with NVIDIA to make their humanoid bots. Tesla is not the only company that's making humanoid bots, so by the time Tesla releases the Optimus bot to commercial customers and consumers, Tesla will face a lot of competition just like its EV business. Let me show you this consensus forecast from Skin Alpha so you will know Tesla's expected growth rates moving forward. This year, Tesla's revenue is expected to grow by around 10%. However, I believe this estimate is too optimistic. Tesla's revenue growth will likely be lower this year because of Trump's trade war and the fact that many people are still boycotting Tesla and switching to other car brands. Over the next few years, Tesla's revenue growth is expected to pick up again, driven by the launch of its Robotaxi service and more affordable EVs. In terms of EPS forecast, Tesla's EPS is expected to grow by around 5% this year, followed by much higher double-digit growth rates over the next several years. Again, I believe these growth estimates are too optimistic. I think they assume that Tesla will start generating much higher revenue and profit from its Robotaxi service over the next few years. Let me show you this fair valuation tool. It's a preview. The orange line represents Tesla's fair value. The blue line shows Tesla's actual share price, and the dotted lines are price targets. Interestingly, Tesla was significantly overvalued during the Trump rally. Right now, Tesla is trading slightly below its fair value line. We estimate that Tesla's fair value should be around $270 per share. In comparison, Elon's average price target is around $375 per share. Our price target is much more conservative at around $300 per share. This means Tesla is either fairly valued or slightly undervalued now. Of course, this valuation assumes that Tesla's Robotaxi service will likely succeed in the upcoming years. So in summary, I believe the market has already bottomed. The US and China will eventually reach new trade agreements and lower their tariffs because both sides understand that the current trade war is a lose-lose situation. Trump will likely grant more tariff exemptions and reduce tariffs once he negotiates better trade deals with other countries. As for Tesla, I'm not planning to buy back the stock, even if it's slightly undervalued. I used to hold Tesla shares in different accounts, but last year I sold my remaining shares and moved most of the money into Nvidia because I believe Nvidia is a much stronger company. In fact, if you analyze all the Magnificent Seven companies, you will see that all of them, except Tesla, have large economic moats. They dominate their industries, are highly profitable, and generate the most free cash flow each year. In comparison, Tesla has the highest 4P compared to the rest of the Magnificent Seven companies. This is why I believe it makes more sense to invest in the other Magnificent Seven companies instead of Tesla. Tesla no longer has the moats it once had. For example, BYD can mass produce EVs at much lower prices than Tesla and still make a profit. Even if Tesla launches more affordable EVs, it will continue to face intense competition from Chinese EV makers. To keep up, Tesla will need to cut costs, lower prices, and maintain very low margins. Moreover, Tesla's upcoming Robotaxi service will face a lot of competition from Waymo, Uber, Lyft, and other ride-hailing companies. The Optimus bot will also compete with Figure AI, Boston Dynamics, and many Chinese robotics firms that are making humanoid bots. This is why I'm not planning to buy back Tesla, even if it's slightly undervalued. Now, these are only my opinions and my analysis that's based on my research. They are not financial wise. There are always risks associated with investing. It's very important to invest in what you know and not speculate. You will need to do your own research and do your extra due diligence first before investing in anything. Thank you for watching this video and supporting our channel. This is Victor from the Intelligent Investor channel, and I will see you in the next video.